Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, this is David Blake with Tuesday Tech Talk, and we're going to just quickly review indexes for the last few days. It's been quite a volatile week, to say the least, after the Brexit vote. And then we're going to talk about how you can profit from the volatility in the market, whether up or down on the VIX. And then we're going to look at a couple of the indexes real briefly, just to show you some areas that we want to look at over the next couple of days to make sure they hold, and whether or not this is just an all-in buying opportunity or what. So at the end of this, if this is your first time here, we take about 20-25 minutes at the end to kind of wrap things up. If you have questions on the different markets or what we just talked about or individual stocks, feel free to ask a question about them, and we'll try to review what's going on. Okay, today's webinar, we're going to touch on a subject that probably most of you have heard people on TV talk about, or you may be aware of it yourself, and that is basically how you can profit and hedge your portfolio by using volatility indexes in the market, particularly the VIX, but we'll also talk about some of the other vehicles. Okay, then we'll look at the major averages and see where the selling should be contained and all. Okay, first slide here, what we're going to look at. Okay, the volatility indexes, first off, they're not for the weak of heart. These things can swing 50% in a day. This last Friday, after the Brexit vote, the VIX jumped 48%. I think at Monday it had like a 12% move. Right now it's down 4 points to 1985. That's a 16.77% swing. So a lot of money to be made. However, again, if you're on the wrong side, you can get hit pretty quickly on these things. All right, first of all, what is the VIX and what does it measure? It's basically kind of used as a sentiment indicator. It measures the stress or how anxious traders are about the market. It can start to rise when we're making new highs, meaning the traders think that the market's probably overvalued, and they're nervous that institutions or something are going to sell the rally. If you have what causes the VIX to move, it can be economic data, it can be political data, like we saw this last week with the Brexit vote. It could even be environmental catalysts, where you see a hurricane coming into the Gulf of Mexico, and you might see the crude oil futures start to show a lot of volatility, and you can actually trade off of that. When you have a low VIX, and by low VIX I would mean the average over the last several years for the VIX, believe it or not, is actually trading around 17 to 19 area. But when you get a low VIX falling below that, it means that traders are getting kind of complacent with the market's move. It will usually happen when the market's trading at a high. I think just a few weeks ago here we got down to at around 13 and 14. That was around the 1st of June. So again, we're getting complacent. People were kind of expecting economic data to pick up. The Fed rate hike was kind of off the table, and that was kind of opening the door for maybe a little bit of a rally, me included. Thought that we could probably break the new highs over the summer, and the VIX was kind of hinting that could be the case. Now, when you get a high VIX, where you see it spike up, around 25 or higher, that usually means that traders are nervous, to say the least. You see this on big sell-offs, on corrections. When it actually gets above 30, that's usually a sign that you may want to start looking to come back into the market. Now, that doesn't mean 30 is going to be the height of it all. I think back in 2008 we got up to 80. So if you ever get a chance to see it up around 45 or 50 or 60, you're looking to come back into the market when everybody else is when there's blood on the streets and you're trying to get out. So right now, we got up to I think about 25 or so the other day on the VIX. Not crazy high, but it showed that a little bit of angst had come in for traders. We've now settled back down to 1981. That's still a neutral reading at this stage. So again, we're down 4.04 points on that today. Okay, the VIX number one is calculated by comparing puts and calls on the S&P 500. It's purely, that determines how much premium is going into it. So when the market's moving higher, and the VIX is low, there's going to be more. That means there's more premium in the calls because the traders think the market's going to be going up. Likewise, when we're going down and there's a lot of premium, the VIX will be spiking higher. Now, this trade's purely on technicals. There's no fundamentals involved. It's purely a supply and demand, and price is determined by the market. You can actually buy you can't actually buy the VIX per se as an ETF or anything. But what we're going to talk about here is vehicles that you can use to do this. Now, if you want to track the VIX on, like, say, Yahoo Finance or something like that, the symbol is a caret sign VXX-IV. Okay, now with the volatility indexes, right now there are currently about 30 different indexes and stocks that you can trade out there. You can trade global markets like China's Shanghai Index, Brazil. You can trade gold, crude oil, energy, the energy sector, different currencies, and even big cap stocks like Apple, Amazon, Goldman Sachs, and a few others. You can actually buy a VIX on that. And what that would mean is maybe you're looking to, maybe you're looking, if you see Amazon get up around $900, you think it's going to get a little bit volatile. And here you may want to buy some. You don't want to sell the stock, but you can buy a leveraged or inverted volatility index on that, or actually buy puts on the VXX. Okay, what I want to look at here, this is a chart currently here. This is the symbol is VXX. This is probably one of the easiest ways to play the VIX without, number one, there's three different ways you can trade volatility. You can either do it with options, you can do it with futures, or you can do it with ETFs. If you're not familiar with futures, you probably just want to stay away from that. There's a lot of, you have to go into erosion of the contracts. You go to a couple of months, that type of thing. Options, as you know, most people lose money on options anyway, so you take that with a grain of salt. But the ETFs will give you a chance to go into play the volatility index and pick up some moves in here, sometimes at 20 or 30 or 40%. Okay, the first thing you might notice is the VIX yesterday closed at 23. I think it's 2360. Okay, the VXX was over here around I think it's 1860 or something like that. And the reason there's a discrepancy between this and the actual VIX is that these are what you're doing. You're buying, trading off of future contracts, which can go out. In this case, the case of the VXX, you're looking out over a 2-month period, so you're not getting the whole one-day volatility in this VIX, but you're going to capture most of it. And usually, if the VIX moves 10% a day, you're probably going to pick up maybe 7% or so on the VXX. Okay, and the reason that you want to look at when this thing spikes higher or gets way down low is because the VIX will generally, the traders look for this to go back to mean reversion, which means that it's going to revert over time back to that maybe 17 to 18, 15 to 16 level on this VXX. So if you have a spike up here to 25, then you still kind of like the market. Then you can buy, like, say, an inverse VXX, or you can buy a put on the VIX on the VXX and hope that it's going to convert down over the next month or so, or maybe week or two, back down to this maybe 16, 17 area. All right. Now, also, if you notice on this chart, the moving averages that I have on here are the 5-day and, well, actually I have the 10-day and the 21-day. Some traders will want to use the 5-day, and the reason being because this is a short-term trading vehicle. You're not looking to buy this thinking, well, I think the market's going to be volatile for the next through the election, so I'll hold on to this thing for the next 3 months. You don't trade it like that. Again, you're looking for short-term moves. You take your profits on these things. If you had gone short over here at this 30, odds are by the time you got over here the next week or two, you're going to be covering your calls over here. Kept on going, and you could stay in there. I don't recommend it because as soon as something triggers, all of a sudden you could get this thing up, 10, 15 points and lose all your profit on it. So again, if you use it for a short-term period where you think there's going to be a lot of volatility, you can use it. You can make some money and profit on it. Okay. If you're really aggressive, this is something called the Ultra VIX. This is from ProShares. The symbol on this is UVXY, and this is a double leveraged VIX. Whereas if you saw on the previous chart over here, you saw that the back here in February, the VXX went up to about 30. Over here, you'll see back in February the Ultra VIX ran up to about 60. So you get a lot more bang for the buck. But in the same way of that, if you're wrong, you could lose 40-50% of your trade money on that on a short-term swing. Okay. Next thing I want to do, how can I actually trade the VIX and trade the market volatility? There's like I said earlier, Ray, there's a few different ways. Number one, you can buy VIX futures, which the contracts go out about 9 months. They trade at a significant premium. You have to figure in time erosion as the contracts roll over and that kind of thing. So that's probably not the way you want to go, even if you're a pretty advanced trader. Now you can buy VIX options, but you're buying the options again on the futures, not on the VIX index itself. So you might all of a sudden see the VIX go up 30%. You look at your VIX options and you only made 15%. You're wondering why. It's because you're buying the calls on a VIX futures that are going out maybe 2 or 3 months. So it's hard, a little bit harder for you to track what's actually going unless you got the futures contracts trading in front of you. Okay, the third way to trade the volatility is to use the ETFs, and I'll go over some of the different ones here in a second. Or you could actually buy options on the ETFs that we're going to present here in a couple of minutes. Okay. Now these are some of the VIX-related ETFs, and again, these are only on basically on the S&P 500. I didn't bring up the ETFs for crude oil and like China and gold and that kind of thing. You can go online and get a list of those, or if you send me an email later on, I'll try to go on and send you a list of them later on. Look at 4 questions if you could figure those out. Okay, so the first one we talked about earlier, the UVXY, that's the ultra double short-term ETF. Again, that's a very aggressive trade. Again, if you're wrong, you could lose 20-30% of your money in a day or so. But if you're right, you could get a move from say like 20 up to about 50 in a relatively short term. Okay, the VXX is one of the VIX short-term futures. You're playing the futures still on the VXX. Like we said, that's why it's not going to be the exact value of the VIX. You can play the VXZ. The difference between that is a little bit. You're going out a little bit further to the midterm futures on the VIX. So you're probably going out 3, 4, 5 months versus on the VXX you're looking out 1 and 2 month contracts. Okay, another way that you can do it, you can play it VIXY, and that's again that's a different. The only difference between that is that you have ProShares, you have iShares, you have just different companies buying making up these ETFs, and they're just going to put some different. They'll have different contracts in them and different future contracts. VIXM again is a S&P midterm futures, so you're going out 3 and 4 months. For 5 months on your VIX trade. Okay, XIV, that's another inverse daily VIX short-term ETF you can look at, and then another one is SVXY, and that's the ProShares inverse daily short-term futures. Again, that'll be looking out 2 and 3 times. So in other words, the inverse ones you're looking at to buy. If we get up here, say, too bad we didn't talk about this a day or so before. But if you go up here and the VIX is up here around 45 and you're starting to see some, whatever made it spike up to that, you start thinking, okay, well, this is probably overdone. And the VIX, the market should find a bottom and maybe start to rally a little bit. The XIV and SVXY would be the way to have the VIX, to play it to come from like a 40 or 45, and hopefully it's going to fall down into the 20s. Okay. There's certain trade triggers I just wanted to mention for you. Again, that what would signal to you that perhaps traders on the floor and all are getting a little bit nervous about about the VIX or the market in general. And some of these is, if you take a chart, which we looked at the beginning there, we put the 5-day moving average and the 10-day moving average. And what you're going to look for, you can look for the VIX to actually cross above or below a short-term moving average. That may mean that you're getting ready to make a move and that people are starting to buy it or short it. Okay, another way, in other words, when the VIX trades 10% above a 10-day moving average, that's usually a sign that you probably want to go long. That's a good trigger that you could get a decent move higher on the VIX. Once you had that move and the VIX trades below the 10-day moving average, and it gets about 10% below that, and 10%, if it goes from 25 to 20, you're looking at it going to maybe 23 to trigger the trade. So that would be a sign that you want to go buy the inverse VIX trades. Another thing that you could look at when you see a spike, if you go on look at some technical indicators, if you put the 5-day RSI in there, and you'll see the spike, it'll go up to, the 5-day RSI could go up to 100. While it's going back and forth and moving around, once that 5-day RSI begins to fall to about 75, 80, maybe even 70, that's going to allow you to go short. That means the VIX is probably coming down. Or if on the other side, if you've had a big, the market's really low, you start to see the 5-day RSI head up above 30, that would trigger a long trade on it. So that's some things that you can look at on the different indicators, just to trigger a trade to make you start thinking about what you want to do with them. Okay, another way you can look at this to prepare yourself for a move. This is convergence and divergence. A lot of times on these talks we talk about some of the different indicators are showing negative divergence. That means the market's going up to a new high, yet we'll see the RSI 14-day making not contributing to it. It's making lower highs than the market. But in this case, if you start to see the VIX go up, and you start to see the S&P 500 and NASDAQ 100 are both going up. This is, okay, yeah, rising VIX plus the market's going up. Okay, this could predict, you may want to start to think of this as bearish divergence, because when the market's going up, you want to see the VIX staying low. Bearish divergence means that we could be predicting a correction or we're getting close to a top. That means the traders are getting lower. That means we're making new highs. The VIX is trading at 14. And all of a sudden you start seeing we're still going higher in the market. You see the VIX move up to about 16, 16 and a half. Okay, that's your bearish divergence coming in, and the traders are getting nervous. Now the VIX is going up while the S&P 500, NASDAQ 100 are starting to fall. Okay, that's bearish convergence. That means that it's confirming that the short-term sell-off is probably here, and that'll allow you to start looking for that trade. Okay, now you see the VIX going down. Plus, this is what we had yesterday actually, where the S&P 500 and NASDAQ were coming down, but the VIX actually came down also. That's bullish divergence, meaning there's a high probability that over the short term the market has bottomed. Now, yesterday we were off 300 points, but the VIX was down 2 or 3 points. So that was your bullish divergence. We would normally think that the VIX should have been rising. Okay, and then lastly, if you have a falling VIX while and a rising S&P 500 and NASDAQ 100, that's bullish convergence. That's also confirming that traders may be getting a little complacent, but you should look for a continuation of the short-term uptrend. So you can look at these things later on. This slideshow will be up probably in the next within the next hour or two, and you can write down some of these things to look forward. But what I wanted to do, because of the move we've had, let me pull this up. This is the Dow Jones Industrials, and there's a couple things that we wanted to look at just real briefly on this. Number one, Friday we held the sell-off on the Dow and the S&P 500 both stopped out at the 100-day moving average. That wasn't the case yesterday. This is we saw some more selling, and we actually broke through the 200-day moving average. We've gone back above that. We want to see how we act on that. The 100-day moving average is around 17.4, and we're at about 17.287 right now, almost 300, 17.3. So we're back above the 200. We want to see what's going on with that. The indicators yesterday were very oversold. We're down here in the low, 10, 12 or so in the stochastic. RSI, 14-day RSI was below 30, and we actually have a MACD long-term is actually giving a bearish trend signal on that too. But one of the things you'll notice is this retracement took out the 32.8% retracement level. A lot of times when you break that, your next support area is going to be the 50% retracement of this whole move back here from the February lows up to the April highs. So you want to look at this thing. We have another day or two of selling. I would think that we probably could go down here and test this 16.8, even with the rally today. Unless this thing comes up here at a 17.8 or so, you're going to have some pretty volatile swings in this. But I think on the downside of 16.8, you may want to start thinking about well, let's see if this thing can hold right around here. Then maybe we could get a little bit of a trade higher. I wanted to put this in here also. This is the Dow Industrials weekly going back 2 years, maybe 3 years. And as you can see, basically we've been in a trading range from this 16.9 or 1600 area up to about 16,000 to 18,000, and just side back and forth filling. Again, we hit that, so if we come down here to 16.8, would be at 50% move on the weekly chart, and if that breaks, then probably you can almost count on coming down here and testing the lows from February. But the 16.8, we'll see if that holds. If it doesn't, boom, we'll come down on this thing. If you remember, if you follow our CTI, that we're expecting the market this cycle, the longer term cycle, to bottom either at the end of the year or the first of the year. We expected to see a little bit of a rally here, and then we were going to a sell sometime in August to see this thing roll back over. Maybe we're getting that now. We'll have to see what happens with the Brexit thing. But again, we're still in that trading range. Watch that 16.8 area to see if that breaks. We'll go back and test this February lows. On the NASDAQ, you can see that a little worse shape. We actually, as of yesterday, we have retraced 50% of that move from the February lows to the actually just topped out in June. That was right around this 4,600. We got down yesterday to 45. 45.94. So right around 4,600. We need to hold right here. If we break through that, you're going to come back down here, and it could be a red flag that we may come back here and test these lows from February. What's also bad about this is we're back in this kind of lower highs, lower lows scenario, which we don't want to see. The indicators are, again, very oversold. We just want to make sure this 4,600, we'll have to watch that over the next couple of days. Break below that, you come back down here around 45 and then to 43. So keep an eye on that. The big one that we talk about here that we were hoping over here that we were going to get a break up through 8,000, and that was going to help us break out the new highs, the Dow Jones Transportation Index. As you can see right here now, we've already retraced from this move. We've already retraced 61.8% of that. We're really oversold. We're up 95 points today, so we're back to 71.80. So we're up right about here. However, what you want to watch this thing here. Once this thing breaks 7,000. Generally, when that breaks, it's almost a trigger that you're going to go down and retest this down 6,600. Now, the close yesterday, and this is also troubling. We're back at in a bear market on the transports. We're officially down 22% from the highs that we made back over here in 2014. So we're down 22%. We get back here, we'll be down around 24, 25%. The indicators are starting to break down. Once you get below this 50% on the 30-day stochastic, it's a negative sign. So you want to watch that thing to see if we're going to go down here to the 6,600 and test that. And that's kind of, I think the Dow Jones Transports will be the canary in the coal mine. That if we can see continued weakness in that, it could bring the whole market down with us. So that's kind of all I have. One other thing, while we're watching the volatility in here, some things that you do want to watch. You know, anybody who tells you they know what's going to happen with the markets with Brexit it's all speculation. We don't know what's going to happen. You know, going forward, this could mean the unraveling of the Eurozone. That would be trouble. That could lead to a recession. Maybe they overturn somehow with legislation in England that they somehow arrange to stay or become a part-time partner. All kinds of things can happen on that. So, but what you're going to watch to give you clues as to whether this thing's going to roll over or maybe stabilize in here. Number one, you want to watch oil. We have a bounce today. Part of that's because the dollar pulled back today. But if crude oil can stay up in the 40s, preferably up above 45, that would add support to the market. Again, with the zero interest rates, you have that support to the downside also. But another thing, if you look at UUP, which is the ETF of the U.S. dollar, we stopped yesterday right at this 50-day moving average, which is important. If this thing goes above that, you could get a break up here to 26.8. You don't want to see that. That's going to give trouble to the emerging markets. It's also going to hurt commodities. That'll also hit oil. That could knock oil down the low 40s. If you see oil go below into the low 40s and start to break below 40, that's going to be bad for the overall market too. And that could induce some more selling. So what also with this dollar, when it goes up, I'm not going to go into the sectors this week, but what it does tell you is that when the dollar gets strong, it's bad for the multinationals, you know, the big industrials that are going to get a lot of their revenues from overseas. They're going to get back in this currency problem again that they had the last couple of years over in this area. It's bad for their earnings and revenues. That'll cause revenues to get cut. And it's also bad for emerging markets, and it's also bad for commodities. So keep your eye on that UUP. Keep your eye on oil. That's about the only thing that's going to give you a clue as to, and also the transports. That's going to give you a clue as how this volatility is going to shake out over the next, say, month or so. Okay, I did have a couple questions that came in earlier on some individual stocks. Hopefully, I can share this thing. Okay, so bear with me while we present the screen. Okay. Okay, can you see the charts right now? Can? Okay, first thing we had, well, I have HYG up first. This is an ETF that's going to look at it's a high yield ETF. It's yielding right now with yesterday's close about 5.7%. This is going out about a year. You can see that yesterday's sell-off, it held at the 200-day moving average. You have the 100-day moving average coming up to provide support with it also. Today we're looking at, let's see. Okay, it's up about 69 cents to 82.76. So your downside to me is limited, especially because of the Fed getting out of the way now. They're not about to come in here and start talking about higher rates, even if we get stronger economic data. At least for the next, I think July is probably definitely still off the table. I don't think they'll do anything right before an election in September. So until they start talking about December, I think the high-yielding corporate bonds are still going to be okay. They're oversold in here. This might be a good entry point. But again, you're not. I wouldn't put full positions in on anything, on any of this stuff. If it comes back down here and takes this out, you want to be careful on that. But right now, this 82, 81.75 is the area that you want to watch for support. Also around 81.40. Yeah, if it breaks down below that, you might have a little bit more back and filling to do. But again, you're not. The problem is you don't know how these currencies and rates are going to start going. They start talking about going to more, how it's going to affect some of these high yielding instruments. So I'm a little bit nervous on that. Okay, one of them that I did like was Simon Properties. This looks good. This is going out a year. But if you take a look at Simon Properties and you go out about 3 years using a weekly chart, this is really nice. You're constantly bouncing off the 100-week moving average. You came down here, you bounced off the 50-week moving average. You're close to new highs. Simon's paying about 3.1% right now. They have a good business plan. It's not overbought yet, maybe a little bit on the 30-day stochastic, but that's usually a good sign when you get up above 80. That means it's going to stay up there. You can see over here when it gets above 80, it usually leads to a pretty good move. I would expect the REITs that have great balance sheets to do well in here. There's another one would be Anally. I think it's A-L-L-Y, I think, something like that. A-N-A-L-L-Y that has a nice balance sheet also. So that would be one to look at. Again, if you look at the longer term, this thing, besides even when rates are kind of going around, you may get some little pullbacks. But I think longer term, Simon Properties is one that you can go into. Okay, we had a question on INDY. This is the India ETF. We run some portfolios over here that we're going to be introducing sometime late in the summer. This was just added about a week or two ago. This is one of the emerging markets that I think you can probably look at. Again, one of the problems right now is a stronger dollar hurts these emerging markets. So you may want to, if you're not in it right now, you may just want to kind of watch this thing. You might get a chance to buy it if the dollar keeps on going up. So this is one of my favorite ETFs. It's actually outperforming some of the other ones currently. So now I want to go over to see what questions we have over here. We have about five people asking questions. How do I get audio? Uh-oh, no sound, or is it me? Should come in over the phone. Plug your mic in to call, restart conference call phone number. Okay, why is the dollar strengthening? Okay, the dollar has been strengthening versus the euro. Obviously, with the problem with the Brexit vote, it's weakening the euro because again, Great Britain was one of the better, it was one of the stronger components of the eurozone. And then, and as you start talking with the eurozone and Japan with negative interest rates, international players are coming in here and they're buying our bonds and our corporate bonds, government bonds, and that strengthens the dollar. Okay, we've got time for about one more question, and then we'll kind of wrap it up. Again, a lot of volatility in here. I wouldn't be real excited to be jumping in here and to buying anything. I looked at a couple stocks we came in here and bought yesterday. You ended up with the only about 13% of the stocks that we follow are above the 10-day moving average. That's always a sign when you get a chance to buy into that. When you get the only 10% or less of the stocks above the 10-day moving average, it's usually a good time where you can jump in here for a quick trade. Like I said, yesterday we got down to 13%, which is a buy signal for a short-term trade. You could have bought some calls for this thing. Okay, you at WTI, and let me see here. I'll pull these up real quick. I'm not familiar with these at all. Unfortunately, we don't follow these. If you will send a request in to support at marketedge.com, we will come in and we can we'll see if we can add them. There is some volume requirements and trading requirements, but we'll see if we can get that. Okay, this has been 35 minutes. I probably went too long again. This presentation will be up on the markets page probably within about an hour or two. And so if you want to look at go over some of the volatility indexes that we talked about, or you have any questions afterwards and you want to email me your questions, I'll try to get back to you later on today. But thank you very much for enjoying it. Hope you got something out of that. And we'll see you next Tuesday. Oh, actually, next Tuesday, we're not going to have a webinar. It's the day after the 4th of July, and I will be out of town. So it'll be 2 more weeks. We'll see you back here. Thanks again.